We're joined by Liz Ann Sonders, Chief Investment Strategist at Charles Schwab. It seems to be a consensus, and I think it's a bit of a tradition at Jackson Hole that they don't say very much germane or they don't reveal very much on interest rate policy.
They don't. But we have to remember last year, even though Powell's speech was quite short, it was also very pointed because that was the time when the market was not just pricing in a pause, which of course a year ago the Fed was nowhere near a pause, but actually a pivot to rate cuts happening in the second half of this year. So there's no matter what, the speech this year is going to be quite different. For me, what I'm going to be listening for more so than any hints around what they do in September, what they do in November, which seems to be the obsession, is does he push back on the rate cuts that are priced into expectations in 2024? Does he reinforce the for longer part of higher for longer? So that's what I'm going to be sort of keenly attentive to. So
the market's investors are still looking for rate cuts next year, Liz.
They are 4-ish or so, and that's a moving target. That does change. But if you look at history and you look at the span of time between each cycle's final rate hike and then subsequent first cut, there's a lot of variability in terms of the time span, but what there is a decent correlation to is the unemployment rate. Lower unemployment rate tends to, you see a much longer period between final hike and first cut, and given a 3-4 unemployment rate, all else equal, that suggests that there's still more work to be done to price out some of those rate cuts, unless there's more than just cracks that start to appear in the labor market.
Still a strong labor market. Now, you're widely followed on Twitter, now called X. Some of the themes that you've been exploring, the narrowness of the market. Obviously, we've heard just a few stocks led the market higher. Give us an update on that, please.
It's not quite as extreme. The most extreme in both directions, and I'll explain what I mean by both directions in a second, was right around June 1st. And that was when not only more than all of the performance was accounted for by the mega cap 8 stocks, which weren't just tech stocks. They span into consumer discretionary and communication services as well. But at that same time, only 15% of the S&P's components were outperforming the index itself over the prior 60-day period. That was a record low, at least as far back as we have data. You did see some convergence early on where you saw some profit taking begin up the cap spectrum. You started to see greater participation down the cap spectrum more broadly. Unfortunately, this recent pullback, we've seen breadth pretty much across the board rollover. So we're not quite as concentrated in performance, but there probably is still a little work to do to have the internals of the market look a bit healthier.
So just to clarify, recent weakness has shown stocks across the board coming down?
Yeah, you've seen breadth deteriorate across the indexes, within the indexes, to a point where I think the relief rally we got a couple of days ago may have been due to technicians saying, okay, we're oversold short term. But I think there's probably still a bit more deterioration to come. Pullbacks, even if they don't turn into corrections, tend to have 3 phases. You get the initial move down, then you get a relief rally, and then you sort of finish the pullback or correction. I think we may be in that step 3 part of the process.
So what would maybe we'll put up a 5-year chart for the S&P 500. Do you have an actual number where you think the S&P 500 could be headed over the next year?
No, we do not do year-end price targets. Frankly, I think it's a silly exercise. Our investors are all individual investors. Some point estimate on a single day, I don't think provides the right kind of guidance. I guess it's a way for the media to pit strategists against one another, who was right, who was wrong. But that's not what we do. So, I think short term, there's probably more weakness. For any reasonably long time horizon, a year out, generally, I'm going to say I'm optimistic. Chuck Schwab, our chairman, one of the best things he's ever said is investing by its nature is an act of optimism. But that doesn't mean you don't have short-term speed bumps along the way. And I think we're in one of those.
But a year from now, you think there's a decent prospect of stocks being higher from where they are now?
Yeah, but I think there could be interim choppiness. I think what is key to the equity market right now, actually, is for volatility to ease on the Treasury side of things. It's not so much the level of yields that's had a big impact on the market in terms of this week and recent pullback. It's the volatility in that market that tends to be more correlated to how the equity market is behaving. And I think that's an explanation that doesn't get enough attention when trying to look at the anatomy of this recent pullback.
So the U.S. government bond, and your mortgages in America near their highest this century, your 30-year mortgages, yep. And U.S. Treasury bond, I know it's come down from its highs, but it has moved up. Why is that? Why have bond yields come up so much?
So I think it's a confluence of things. Better than expected economic data, ongoing stickiness in inflation, a lot more supply that's come into the market with the Treasury refunding. Concerns about the deficit and net interest costs have led to some selling, which puts upward pressure on yields. And then the transmission mechanism to the equity market is particularly important this year because all of the rally since last October came from PE expansion, no benefit from earnings. So it's all been multiple expansion. And when you see that rise in yields, that means a higher discount rate. All else equal means future earnings are less valuable. And in turn, the more highly valued segments of the market tend to see more downward pressure when you're in that rising yield environment. So that's sort of the why has it happened and how, what's the transmission mechanism into the equity market.